So I think I warned you about this the other day. And what I said was like, this is the chapter where people's brains get broken. Even though it's like later, you'll be like, I can't believe it seems so hard. But when it's new, it just seems hard because it's new. Okay. So recognize that there's two different ways people can do accounting. One's called an accrual basis of accounting, and the other is called a cash basis for accounting. What we've been introducing to you without really telling you is something called the accrual basis of accounting. So in the olden days, everybody just did accounting with the cash basis, which in essence means when you pay out cash, you record it as an expense. When you receive cash, you record it as a revenue. The problem with that way of accounting is that sometimes you do work for people, meaning you earn revenue before they pay you. In fact, it's pretty normal in business to give people 30 days to pay or 60 days to pay you. That's really normal. And also there's times when you have expenses that you maybe don't pay for right when you do it. Maybe someone delivers goods to you and they tell you can pay them in 30 days. Or sometimes the opposite happens where someone pays you in advance, but you haven't actually earned the revenue. That happens a lot in the storage business where people pay you for a whole year's worth of storage, but you really only earn 1 month's worth at a given time. And so the accrual basis of accounting tries to solve for that. Because what happens is this, is if you pay me for a year in advance of services and I record that all as revenue today, I'm going to have this big chunk of revenue on my records today and then no revenue for the rest of the year, even though I have the costs associated with providing that service to you over the rest of the year. And so it creates all sorts of problems. So accrual accounting is where we match our revenues with when we earn them, not necessarily when we receive money. And we match our expenses with when the term they use is incur. So when we I guess you'd say you earn the expense, so to speak. You receive the service or the goods or whatever, okay? So we match those up with the time period in which we either earn the revenue or incur the expense rather than when the cash changes hands, okay? But that creates its own set of issues, is how do we track this where I receive cash in advance and what is that cash and how do I deal with it? Or when I pay something in advance, how do I record that on my books? So yeah.
I got a question about that. So you get paid for whatever services in advance.
Mm-hmm.
Is it only kind of like by month basis? Then you put that money into or an account that would be interest.
Mm-hmm.
If so, you keep that into your final year. Statement.
Right. Yeah, no, that's a good question. It's kind of exactly what we're going to get at today. So she says, if you get paid in advance, what do you, this is for the sake of the recording, this is unidirectional, they won't hear your question. If you get paid in advance, what do you do with that money? Do you have to put that money in a savings account so that it's safe and it's there? And then how do you record it and how do you deal with that, right? And so first of all, usually if I get paid in advance, that money just becomes part of my operating money. And so I don't put it into a separate account, but I have to record it. Think about this. If somebody pays you in advance, your cash goes up, but your revenue doesn't go up because you haven't earned the revenue yet. So instead you have to record it as something else, and you record it as a liability, it's called unearned revenue. Yeah, that one's confusing because it has revenue in its name, so everybody thinks it's a revenue, but unearned revenue is a liability. And why it's a liability is because I owe that person either the services I promised when they paid me in advance, or I owe them their money back, one or the other, right? And so this whole chapter is about how we deal with that, how we receive that cash and record that unearned revenue liability, and then over time, we start to record the revenue we've earned and reduce that liability as we earn it, okay? And so that's what this whole chapter is about, and it gets confusing sometimes because you're dealing in multiple time periods. So remember, a fundamental basis of accounting is that it's periodic, meaning we work in periods of time, usually a month or a quarter or a year. The most common you'll see is a month or a year, and then quarterly, that's 3 months, right? A lot of businesses work in quarters. So let's see if I can get this to work. All right. So the cash basis of accounting, where things don't match up, it's simpler in some ways, but it's actually not legal, I guess. It's not approved by in generally accepted accounting principles because things don't, because cash doesn't match up with when you've earned it and so forth. So some very small businesses, like when you file your taxes as a really small, like a micro business, they'll allow you to use a cash basis, but it's because usually those businesses work in cash, right? They really do get revenue when they get cash and really do pay cash when they do their expenses. They're not doing, all sorts of crazy stuff. So I mentioned this. These are terms that you'll need to know. Use and the accrual basis of accounting, we use something called the revenue recognition principle. Okay, and what that means is revenues are recorded when they're earned, which means when the services are performed or when the products or goods are delivered. Okay, so that's when we record revenue. Even if we don't get paid now, but are going to get paid later, or even if we were paid in the past, we still don't record it as a revenue till we earn it. That's a really important principle. And then similarly, the expense recognition principle, expenses are incurred, must be reported in the same period as its related revenue. Okay, and they call that accounting, they call that the matching principle. So remember, all an expense is a cost. If you think about it, it's a cost of doing business. Another way of putting that is it's a cost of earning revenue. So we have to match our costs of earning revenue to the revenue we earn with it. Okay, so if I'm paying employees, the reason I pay employees is to work, and the reason they're working is to help customers, and the reason we're helping customers is because that's how we earn revenue, right? So we want to match their pay to the same time period in which we're getting the revenue for that. And that's the idea. So this whole chapter is on what's called adjusting entries. And we do adjusting entries to recognize the revenue or expense of something that where the cash doesn't match up with the revenue expense. And I'll give you some examples here. So we break these into two broad categories, the two types of adjusting entries. So the first type of adjusting entry, sorry, I'm looking for a marker. I guess somebody just thought they would just take them because, I mean, oh, there it is. It's hiding. The first type of adjusting entry is what's called an accrual. And the second type is called a deferral. Can anybody give me a definition of those words? Like just like, what does it mean to accrue something, or what does it mean to defer something? Those are words we don't use a lot anyway. Do you know what it means to accrue? Okay, he says to gain. So yeah, when we accrue something, it means we gain or something over time, usually, right? When someone says like he's accrued wealth, it means he's like saved up wealth over his lifetime. So accruals have to do with bringing things in, okay? And then defer something means to put it off to the future, right? When we say we deferred, like in the military, they say you have a deferred enlistment, right? Deferred enlistments, which means you sign up now, but you're not going into the military until some point in the future, right? All right. So an accrual occurs when a revenue has been earned or an expense has been incurred, but has not been recorded. Okay. So we're accruing this, which means we are gaining this revenue or expense, but it hasn't been recorded. And I'll give you some examples in a minute. Just remember that definition. So an accrual for a revenue, our adjusting entry, well, I'll go over these adjusting entries in a little while. So here's the idea. You'll see in that first, so the first little T account shows the initial recording. Everybody see that, what I'm talking about? And then to the right of it is its end of period adjustment. So here's what happens. When we accrue revenue, We've earned revenue, but no journal entry has been made. This happens in a lot of businesses, especially businesses that bill for time. So attorneys, CPAs. What happens is, as we do work for our customers or our clients, we're earning revenue because we're doing work for them. But then usually we just wait till the end of the month and then we sort of tally up all the work we did for them. And at that point we bill them, okay? So remember, we work in periods of time. Accounting is periodic. So in order for me to have the correct revenue showing on my income statement at the end of the month and the correct assets and liabilities and equity, I need to go ahead and record anything I've earned during the month at the end of the month if I haven't yet recorded it. So if I did work for you all month and I don't record that, then my numbers are going to be off, right? I'm not going to show all the revenue I've earned. Or if I've incurred expenses all month but haven't recorded those. So what you normally do is at the end of the month, you do what's called an adjusting entry. Okay, that's this whole chapter's on adjusting entries to show that we have earned that revenue, or we've earned that revenue. So for an accrual, so for an accrued revenue, our adjusting entry at the end of the month is going to be to record the revenue and to record that we haven't received it yet. So it's always going to look like this: accounts receivable, and whatever the revenue account is. Okay, I'm just going to call it revenue earned. So there's our first type of adjusting entry. Accrued revenue means we've earned revenue, but we have not yet recorded it. So we do an adjustment at the end of the month to show that we have earned it. So we credit revenue and that it's owed to us. We debit accounts receivable. Okay, so that's the adjusting entry for accrued revenue transactions. And remember that an accrued revenue transaction is a transaction where we've earned the revenue, but have not yet been paid for it and have not yet even recorded it. Okay, very common in a lot of businesses, even in like construction businesses. A lot of times, they'll do work for people and then just bill them at the end of the month. Okay, it's really a normal thing to do. Okay, so that's right. So the adjusting entries. Here's a couple rules that might help you. Adjusting entries always occur at the end of the month. They're always entered on the last day of the month to make any adjustments for, like in this case, revenue that was earned but has not yet been recorded. Okay. The other thing is adjusting entries never involve cash, ever. Okay. Because remember, all of these arise from the fact that we either did work without cash or we got cash in advance. But the adjustment is to show how we've either earned the revenue or how, you know, it's always to deal with revenue or expenses, not to deal with the cash part of it, which is an interesting thing to get used to. So that's an accrued revenue. The adjusting entry always looks like that: accounts receivable, debit, revenue earned, credit, every time. Okay. The revenue earned might be called something different depending on the business you're dealing with, right? It could be fees earned, it could be rental revenue, it could be lots of different names for the rent or for the revenue account, but that's how the accrued revenue works. The second one we have down below there, it says accrued expense. So this is where an expense has been incurred, but no journal entry has been made. So sometimes people deliver goods or things to us, but we don't record them. So at the end of the month, we go ahead and record that so that our books will correctly show, and our statements, our income statement will correctly show all of the expenses for that month. Okay. And so again, it's going to look like this. So here's an accrued expense. It's going to have the expense, whatever it is, on the debit, and then it's going to have the account payable on the credit. So this is recognizing some sort of expense that we've incurred. A very common one, if you think about it, is our employees are working all the time. And here at the college, we're all working, doing our job, but we don't get paid till payday. Okay, so at the end of the month, we might find that our employees have worked so many hours this week, but we're not actually going to pay them until next Friday or whatever, which is payday. So again, we would have to do an adjusting entry to recognize that we've incurred a salary and wage expense, but we haven't paid it yet. So we'd probably call it salaries and wages payable. Then on the next payday, we'd pay them and we get rid of that payable and we'd be good. Again, so the whole intent of these is so that our books are accurate for the end of the month, so we can do our end of the month reporting. So we can report our revenues and expenses, even if we haven't yet paid them or yet received the money. Okay, that's the whole purpose of accruals. All right, the second type are called deferrals. So remember, the idea of a deferral is putting something off to the future. So this happens when we record something, usually like I mentioned, like the unearned revenue, right? So someone gives us money, I've recorded that as a liability, and now I've actually earned some of it during this month. Okay, so what was put off to the future has now come, and I have to record the fact that I've earned it. Okay, that would be like a deferred revenue. So here's what the transactions look like. So with an unearned revenue, they call it, which is a type of deferral. So our initial transaction was that cash has been received for revenue that will be earned in a future period. So the initial recording when someone gives me the cash looks like this. I debit cash, cash goes up. I credit unearned revenue, a liability account, right? That goes up. Then my adjusting entry, my end of period adjustment, is going to be a debit to unearned revenue. Remember, that's a liability account, not a revenue account. And a credit to the revenue account. So think about what that means. It means the liabilities decrease with the debit. So the liability, unearned revenue, is going down and the revenue is going up. So let me talk through one more time what's happening. Think of my storage. Someone comes to me and says, hey, it's $40 a month. Can I just give you $480 for the year? So that way I don't have to worry about it every month. And I say, yes. So when that happens, my initial transaction would be to record cash going up by 480 and unearned revenue going up by 480. In other words, I got cash and I owe it all back to that customer, either in the form of services or in the form of a refund, right? Then at the end of each month, I want to recognize during that month, I earned 1 month's worth of rent, $40 worth. So I'm going to do this adjusting entry, which is going to reduce the unearned revenue by 40 bucks and increase, for my company, it was rental revenue by 40 bucks. So then I do that every month for the next 12 months. And at the end of that 12 months, the unearned revenue account's gone. I no longer have a liability. And in my rental revenue account would have a balance of 480. So in essence, I got the cash here and then earned it at $40 a month over the next 12 months. Okay, so the adjusting entry is my way of reducing the liability and increasing the actual revenue as I earn it. Yeah. Yeah, that's good. So we keep what's called a, just to use another big weird term, we use what's called a subsidiary ledger, which means like a sub account of the account unearned revenue in the name of each customer, or by account number or something like that. Right. Right. Same thing with accounts receivable. You have accounts receivable, you know, the whole amount, but then that's broken down by customer within the accounts receivable. And in your accounts payable account, you might have one accounts payable, but it's broken down by all the different vendors that you owe money to. Yeah, good. That's a good question. All right. So that is a deferred revenue. Our adjusting entry is always going to be a debit to unearned revenue, so decrease the liability, and a credit to revenue, increase the revenue. Okay. And then a deferred expense is one where we have, so we've already seen an example of this in the work we've been doing. A good example would be like supplies. So we record supplies when we buy them, but we don't take the expense, right? We've seen that in the work we've already done. So I buy $1,000 worth of supplies, I debit supplies, I credit cash. That's my initial entry. Then at the end of the period, I count up how much supplies I've used. Usually what I do is count up how much I had there and subtract that from the amount that was the balance, and the difference is the amount I used, right? And then I do an adjusting entry that's going to list debit the expense, and it's going to credit whatever I'm going to call it the prepaid expense. Prepaid expenses are an asset account. So in the case of supplies, our initial entry, increase the asset supplies, decrease our cash, and then our adjustment at the end of each month is to record the expense and reduce the asset. Other forms of prepaid expenses are things like prepaid insurance, prepaid rent, right? Like if my cut, you know, think of how I just described how this works from my side when the customer pays me in advance. Well, from his side, he prepaid $480 or $480. What would that be to him? It's an asset called prepaid rent because he's owed the use of the building for the next 12 months. Okay. Then each month he wants to reduce that asset prepaid rent and record it as an expense because now he's used up a month's worth of that. Okay. So that's the deferred expense. Yeah. If it has prepaid in its name, it's pretty much always an asset. The most common ones you'll see is prepaid insurance. It's really normal for people to pay a whole year's worth of insurance, as an example. Prepaid rent. And then there's the other thing where they're not prepaids, but they're like the purchase of an asset, like supplies. And we'll talk about depreciation here in a minute, which is another kind of confusing thing. So those are our 4 types of adjusting entries: accrued revenues, accrued expenses, deferred revenues, deferred expenses. That's it. So honestly, if you, with a little bit of effort on your part in application, you can memorize 4 things. And then you start to see the patterns in it, and it becomes easy in time, right, as you use it. All right. So here we go. This is our NetSolutions company. This is what they call, what I taught you as a trial balance before. We're going to change its name now and call it an unadjusted trial balance. Because what we do is we get to the end of the month, we tally up all of our ledgers, and we get a trial balance. And then we make our adjustments. And then we're going to create what's called an adjusted trial balance after the adjustments. So let me walk you through some examples of adjustments and see if it's helpful. So here's their first one. Assume that NetSolutions signed an agreement with Dankner. Oh, Dankner. Danker would be better, actually. Like that meme was dank, but that one was Danker. I'm pretty sure that's a word, but Dankner works for me. Anyway, they signed an agreement with Dankner Company on December 15th to provide services at a rate of $20 per hour. As of December 31st, NetSolutions had provided 25 hours of services. Okay, again, really normal. They're just doing business. They're providing services to these people. They get to the end of the month, they're going to tally up how much they're owed. Okay, so their adjusting entry for that accrued revenue is going to be to debit accounts receivable, right? That's money owed to them, and to credit their revenue account. In this case, it's fees earned. So $20 times 25 hours is $500. So the adjusting entry is debit accounts receivable 500, credit fees earned $500. And that little part down below where it says accrued fees, that's just a note for them, okay, why or how they're doing it. So there's our first adjusting entry. And again, as part of like a cycle of accounting, we actually do this, okay? We start at the beginning of the month, we record all of our transactions. We get to the last day of the month, we do an unadjusted trial balance. We enter all of our adjusting entries. Then we create from that an adjusted trial balance. And then from that, we create our statements, our income statement, our balance sheet, etc. Okay, that's the process that used to be used when it was done by hand. Now it's still used, but it's done by computer. All right. NetSolutions pays its employees bi-weekly. During December, NetSolutions paid wages of $950 on December 13th. So that's their first payday in December. Looks like they pay every other Friday. And $1,200 on December 27th. As of December 31st, so the money people earned on those 3 days, right, haven't been paid for. So as of December 31st, they owe $250 of wages to employees. So they're going to have to enter an accrued expense where they'll debit the expense account for the wages that were incurred between the 27th and the 31st of the month. So they'll debit the expense and credit the accounts payable. In this case, they're going to call it wages payable, a special type of payable account. Okay, so there's our adjusting entry: debit wages expense, credit wages payable. Let's see. And then this is just showing us in the future on January 10th, when they actually pay the wages, what it would look like. So in the future on January 10th, their next payday, they're going to debit wage expense. That would be for any wages that were incurred from January 1st to January 10th. Plus they're going to debit wages payable. That was for the wage expense that was incurred those last 4 days in December. And then they're going to credit cash because that's all the cash going out. Okay. So with these accruals, what's happening is in essence, we're doing the adjusting entry, and then in the future, we're doing the entry to bring the cash up to it. With the deferrals, we got the cash in advance, and then at the end of the month, we're doing the adjusting entry to show that we've either earned it or incurred it. Okay, that's, again, the more you do it, the more comfortable you get with it. All right, so that's just showing us, okay. So here's our unearned revenue. So December 31st, the unadjusted trial balance of NetSolutions indicates a balance in the unearned rent account of $360. This balance represents the receipt of 3 months rent on December 1st for December, January, and February. At the end of December, 1 month's rent has been earned. So apparently they're renting space to somebody. Somebody paid them for 3 months worth on December 1st. So at the end of December, they're going to recognize 1 month's worth. So if we have 360 in the account and that represents 3 months worth, then the amount of the expense is going to be 1/3 of that, which is $120. So as you can probably guess now, as I walk through a few examples, the hardest part of these is not so much like the math on it, it's the figuring out which accounts are in play and then figuring out how much of it is happening. You have to read that carefully and say, okay, the balance is 360, that represents 3 months. Here, we're only talking about adjusting for 1 month, so I'm gonna have to divide that by 3. That's like the most challenging part of this because it's super easy to get that mixed up as you're working on it. So their adjusting entry, it would be to debit the unearned rent account and then credit the rent earned account. So they debit the unearned revenue. So if I took any notes at all, it would be this that I've just given you, these 4 examples, because the adjusting entries always follow these. It's also in your book, by the way, but I'm just letting you know, like, this is what's going to help as you get stuck on some of these. All right, prepaid expense number 1, December 31st, adjusted trial balance indicates they have a supplies account with a balance of $2,000. Some of these supplies were used during December and some are still on hand, meaning they're not used yet. Assuming that on December 31st, the amount of supplies on hand is $760, then we have to figure out how much we've used, right? So we take the $2,000 that was the balance of the supplies account, we subtract the $760 that are still on hand at the end of December, which means we used $1,240 worth. We've done this entry already in previous chapters. And so we're going to then debit the supplies expense account and credit the asset account. In this case, it's supplies. Okay, because think about what's happening. The asset's going down. We're recognizing that and we're claiming it as an expense, right? That's what happens as we use up expenses or assets, as we claim them as an expense. Here's one with prepaid insurance. Debit balance of $2,400 in NetSolutions prepaid insurance account represents a December 1st prepayment for 12 months. So if it's $2,400 and that's 12 months worth, then how much is it monthly? 200. Good. So you just took 2,400 divided by 12. That gave you 200 per month. At the end of December, the insurance expense account is increased. The prepaid insurance account is decreased by 200. So we're going to debit insurance expense to show that we've incurred the cost of insurance for a month, and credit the prepaid insurance account to show that that asset is now $200 less because we've used it up. Okay. Okay, so we have a special kind of deferred expense to consider, and it's called depreciation expense. Has anybody ever heard of the term depreciation? Okay, so this book gives what I consider to be a not very good explanation of it, just from my opinion. So depreciation is an accounting term when we're in accounting class. It has nothing to do with an asset losing value, because sometimes an asset could be worth more, like a house. It could go up in value, okay? But it has everything to do with us allocating the cost of the asset over its useful life. So in other words, if I buy a computer and I think it can last 4 years before I have to replace it, and I pay $1,000 for it, again, do I want to just take a $1,000 expense this year? Or is it better to take a $250 expense for the next 4 years and recognize that that cost of that computer is spread out over its life? And the answer is, it's better to spread it out, because we're probably earning revenue from the use of that computer somehow over the next 4 years. So we have to, the matching principle tells us to spread that out. So depreciation is the process by which we recognize the cost of an asset as an expense spread out over that asset's useful life. Okay, so we depreciate what are called fixed assets or plant assets. Usually that means each company has a slightly different, they'll kind of set the parameters, but like here at EAC, if an asset costs more than $1,000 and is expected to last more than a year, then we call that a fixed asset, as opposed to a supply, which is something that is expected to just be used up. Okay, so the most common fixed assets that you deal with will be land, building, equipment, that sort of stuff. Those are the fixed or long-term, you sometimes see them called long-term assets. For whatever reason, the IRS does not recognize, and therefore we do not depreciate land, but we depreciate all other fixed assets. Yes. So depreciation means I'm trying to not use giant accounting terms, the allocation of the cost of an asset over its useful life, or the taking as an expense the cost of an asset over its useful life. I would actually say you're expensing the asset. Okay, you're actually taking, so I'll give you an example here in a minute. But again, if I buy this computer and it lasts for 4 years, instead of charging myself $1,000 expense today, I'm going to spread that out over the next 4 years and do $250 a year. That's what depreciation means. Okay. To do this, we create a special account called accumulated depreciation. And that is how we track, because what we're going to do is we're going to leave our asset account always at the cost, and then we're going to attach this second account to it to track the depreciation, called an accumulated depreciation account. And they're giving you a new term here. An accumulated depreciation account is a contra account, in this case a contra asset. Okay, and all contra means is it's an asset account, but that has a normal balance on the credit side, on the opposite side of the regular normal balance of that account. Again, when I give you an example of how it's used, that will help. All right. Let's see, that doesn't give us a great example. So, yeah, that's not great. It just says NetSolutions office equipment depreciates $50 during December. So our entry to recognize that depreciation is going to be that we'll debit depreciation expense $50, and we'll credit the accumulated depreciation account $50. I don't think that's really helpful. So let me give you this example with the computer. So when I purchased the computer, I'm going to call it computer equipment. When I purchase it, the asset computer equipment goes up by $1,000, and my cash, right, would go down by 1,000. So that'd be my initial entry when I purchase something like a computer, is I would debit the asset computer equipment, credit the asset cash. That'd be the first entry. Then what I have to do to figure out depreciation is I have to make some estimate as to the useful life of it. So in real life, accountants do that. They just have to make some estimate. So we made an estimate of 4 years. So we're going to say, if it costs 1,000, we're going to divide that by its useful life. That's going to tell me how much depreciation I will do per year. Okay. If I was doing monthly books, then I would have to divide that by the number of months in 4 years, right? To figure out how much monthly depreciation I would do. Okay. So we're going to do an annual book. So we're going to do $250 per year. So at the end of the first year, what I'm going to do is I'm going to debit what's called depreciation expense, $250, and I'm going to credit accumulated depreciation account, $250. And so there's a separate accumulated depreciation account for every asset I have. So this one's called accumulated depreciation, computer equipment. Okay. I'd also have one for building or for trucks or whatever I was depreciating. So after I do that, you can see I didn't change my computer equipment account. Its balance stays the same as my cost, but I'm going to have another account called accumulated depreciation. I'm just going to call that AD computer equipment. And now that's going to have a credit balance of $250. Accumulated depreciation accounts are always linked to their specific asset. Okay, so the accumulated depreciation computer equipment account is linked to the computer equipment account. And so the term that you'll see come up is book value. If someone says, what's the book value of an asset? It's the cost of the asset minus its accumulated depreciation. So after 1 year, our computer equipment book value is going to be $750. And it'll actually show on the balance sheet. It'll say, in the asset section, it'll say computer equipment. And then there'll be a second line that will say less accumulated depreciation. And then it will give you a total of $750. Okay, 1,000 minus 250. At the end of the second year, we're going to do this exact same adjusting entry. So now this will have a balance of 500. And at the end of the third year, we'll do it again. And at the end of the fourth year, and now we'll say that asset, computer equipment, is fully depreciated. It doesn't mean it's worthless. Maybe the computer's still working. Maybe we're still using it. What it means is we have fully claimed as an expense the cost of that computer. Again, don't get into your head that we're talking about the value of it or the usefulness of the item. That's just an estimate. Some computers might last 10 years, right? I don't know. But based on past experience, we had to make an estimate of 4 years. And so that's how we claim the expense of it. So all we're doing with depreciation is we're claiming the expense of the cost of the asset spread out over time. That's all. As you do more, again, I see some of you look worried. Don't worry, you can do this. All right. So here's a summary of the adjusting process. I'll just let you look at that for a second and not talk to you. That's what we just went through. The other good news is we will do a guided assignment on this tomorrow, right? So we'll go through it. There's a summary of the adjusting entries. Again, those are just the ones I just went through. You'll see they all have the date of the last day of the month, because adjusting entries are always made on the last day of the month. Here's the ledger, so you'll see the new balances of each of those accounts. You'll see cash didn't change because there's never cash in adjusting entries. But accounts receivable changed. And you'll actually see like they'll be labeled as adjusting entries when you see in people's books. There's the other accounts that were changed. And then at the end, since we made changes to accounts, we're going to have to adjust our trial balance. And that's going to be called our adjusted trial balance. Once you have your adjusted trial balance, which means all your revenues are right and your expenses are right, and any of those assets that were impacted by those changes and liability accounts, now we can use that. We have all the info we need, right? These top ones, assets, liabilities, stockholders' equity. We can make a balance sheet. Dividends. So now we can use that to make statement of retained earnings. And then revenues and expenses, we can make our income statement. So that's why the trial balance, right? It has all the info you need to prepare those statements. Nice and handy. Last little concept, last chapter, they introduced the idea of horizontal analysis, which was comparing multiple time periods, okay? In vertical analysis, what we do is we compare one item with a statement against all of the others. So on an income statement, we always compare our revenue. And what that lets us do is say, hey, what are our expenses as a percentage of our revenue? So this business, J. Holmes Attorney at Law, their revenue was $187,500 in 2017. And then you can see all their expenses. So you'll see the percent next to fees earned is 100%. That's set as the base amount. And then all the other items on the income statement are compared to that. So now they can see that their wage expense was 32% of their revenue, rent expense was 8%, and so forth. So that's what when someone says vertical analysis, all they're meaning is with an income statement, you compare every item on the income statement to the revenue to understand better how your expenses compare to your revenue. And on a balance sheet, you would compare everything to the total assets number, okay? All right, that was it. I know